Good morning, everyone. Welcome to another rundown of global stock markets and what's really propelling markets in the medium term, because there's certainly a lot of noise around at the moment in the market, a great deal of volatility. We saw markets extremely negative throughout the week until Friday night, when there was a pretty decent reversal in the US market, or actually the reversal started late on Thursday and then followed through on Friday, and it's really pretty normal sort of behavior for this stage of the market cycle. Lots of volatile ups and downs, and quite often it's hard to see through all that noise as to where the big picture trends are. But from my perspective, the breakdown of markets is still in progress. Yes, the lows have held. Markets were oversold. We've had a bounce. That's absolutely normal. But to me, clearly the trends are to the downside. So let's get into it and have a detailed look at what happened last week and where markets are likely to be heading. So as always, I just want to start with a few opening comments that just kind of put everything in context, because really you have to put stock market action either at an index level or an individual stock level, and you've got to put it into the context of a bigger picture. There's no point in looking at a stock. I get plenty of emails from people saying, what do you think of stock XYZ? Well, it's a question that can't be answered, because it has to be in the context of what's going on at a bigger picture level around the world, and how much exposure you should have to the markets. And secondly, it's always in the context of your own portfolio and what you're trying to achieve. So, that question is really just a redundant one. So let's have a look at the bigger picture backdrop. And to me, markets are closer to the start of a bear market than the end. Now, I know that we're only just kind of borderline bear market now for a number of indices. In America, there is a high percentage of the stocks that are already in a bear market and have been so for some time. So to me, this is a bear market that is just really getting started. We've seen let's call it a mini crash in European banks. Deutsche Bank was down well over 50% from its peak. We've seen other major European banks, Credit Suisse, UBS, showing very, very significant losses of between 35 and above 50% since their peaks. And whenever you see that sort of thing happening, you know that there's a much, much bigger picture at play here. And I think part of it could be that people are finally starting to lose confidence that central banks either know what they're doing or can control anything. And if you really read Janet Yellen's testimony to the House on Wednesday, I think it was, it was almost laughable, some of the things that she was saying, and she's the head of the central bank of the world, so it's quite extraordinary. Now, from an overall perspective, it's hard to see how markets can push back to their previous highs, and I'm talking about 2100 on the S&P. I just really can't envisage that happening at the moment. So for me, the risks are unquestionably to the downside. Sentiment is negative. There are a lot of potential triggers out there that could trigger a sell-off, from devaluation in the Chinese yuan to more quantitative easing from the central banks. The Fed is also now at least conceding that they might even have to go negative interest rates themselves. I mean, it was only December that they started raising interest rates after 10 years, and now they're conceding that, well, negative interest rates as they have in Japan and Europe are not necessarily off the table for the Fed. So, I mean, if they did have to take that step, I think it would be a huge negative, because people would look at that and say, well, the Fed's just got no credibility left at all, and things are out of control. So I think that would be a very negative thing for markets. Despite all the unprecedented central bank stimulus that we've had since 2009, clearly, without any question, it's not working. The global economy is slowing. and many global indices are in a bear market. Okay, the S&P is not quite yet. The Nasdaq is absolutely borderline, but close. So there are a few that aren't yet in a bear market, but gee whiz, there are an awful lot that are. So clearly the massive stimulus that has occurred is just not working, and it's not even now holding up asset prices, which is, one of the things that it was meant to do. The two of the things that really concern me are the amount of liquidity that is in certain markets, not in all markets, and the amount of leverage that hedge funds have got into some of those illiquid areas. Now, one of the problems with that is that in an illiquid area, if you've got forced selling and you can't physically sell that asset, then hedge funds have to sell other high quality assets, and that's really what happened in 2008. You might remember that the price of gold went down, the price of gold stocks went down at a time when you would have thought people would have been flooding into them. But that was because they happened to be more liquid investments and they could be sold, whereas a lot of other things just couldn't be sold. The market didn't exist. So in that sort of environment, when you get forced selling due to margin calls into illiquid markets, it completely trumps fundamentals and value. They become not completely meaningless, but relatively unimportant in those sort of circumstances. It's just a case of selling fuels more selling. Now, I'm not saying we're there yet. However, it's a possibility because certainly the leverage is there, the illiquidity is there in some markets, and the sentiment is negative, and there's plenty of potential bad triggers. So we're certainly in an environment where such a breakdown in markets could occur. Now, don't get me wrong. I'm not saying it will occur. I'm not, trying to join the queue and be a doomsayer. I'm just saying the circumstances are in place where a market breakdown could occur. Let's look at the American stocks. The S&P was down by 15 points for the week, which wasn't very much in the end, but that was thanks to a pretty decent bounce on Friday night. So the lows are holding for now on the S&P. But as I've said many times, if you look under the hood on the S&P at individual stocks, and I look through hundreds and hundreds of charts, it is really, really ugly. So the S&P, if that's all that you're following and that's all that you're assessing your view of the US market, then it's quite misleading because a very significant portion of the US market has broken down very badly. Junk bonds continued to decline strongly, as indeed they should, because they were just completely mispriced. And fear over European banks, as I mentioned earlier, Deutsche Bank, Credit Suisse, etc., is really damaging sentiment. And the concern is that whilst we don't have a recession in the US at the moment, it could become a self-fulfilling prophecy because people become so fearful that they stop spending, businesses stop hiring, and you end up putting yourself into a recession that you didn't necessarily need to have. Again, not saying that'll happen, but the sentiment really at the moment is so awfully negative that you couldn't rule it out either. Let me just look quickly. The Australian dollar finished at 71 cents for the week. It's still just really in a trading range that it's been in for some time. Despite the US dollar coming off, it still hasn't been able to break resistance yet. And of course, our dollar is still heavily tied to commodities, and it's almost implausible to see commodities staging a major rally outside of gold. That's pretty much it. The ASX 200 fell by a very large 211 points, but that will there will be a partial clawback of that on Monday, thanks to the US. But 46.50 still remains the next target for me. We're probably going to get a bounce in global markets for a few days, few weeks, I don't know, but I still think that 46.50 is a target. And one of the reasons that I think that's the case is that 40% of the Australian stock market is owned by overseas hedge funds and other interests. And if they're looking at Australia and they've got money in Australia and they think the long-term view for the Australian dollar is down, then that's going to be a high selling motivation, or if they're not in the Australian market, that will be a deterrent to coming into the Australian market. Even though our yields are attractive, they could lose more on the currency than they could make on the yield. So I think that's one of the reasons that our market's going to continue to struggle. Let's have a look at some charts. We'll start with the S&P 500. Just pan back here a bit. You can see that these lows have continued to hold. So the lows of October 2014, which was the last significant retracement that we had a retracement in August and September of last year, which formed slightly higher lows, but then we've tested those again twice. Now, for now, they're holding, and this is an absolutely critical level. If this level doesn't hold, then I think you'll see a wave of technical selling that would drive the market down quite quickly to 1728 and possibly to close to 1600. So I think those, if the 1810 level breaks, then those two levels are definitely in play. That's for sure. I would also get pretty nervous if there is a fourth retest. So we've had 1, 2, 3. If there's a fourth retest of this level without much of a bounce, then I think the likelihood of that support level breaking is extremely high. So you can see we had a late reversal on Thursday. The market managed to climb off its lows, and then we had quite good follow through on Friday. So I think there's a very good chance that we'll get a bit of a bounce. Could push up to 1877 or possibly 1894. I'd be surprised if it went much further than that, but look, you never know with short covering rallies how they can play out. But I think it's probably not going to bounce too far, and it will be the nature of this bounce over the next few days that will tell me quite a lot about where the market is likely to be headed. This is the bigger picture monthly chart that I always look at. Hasn't really changed much. You can see that certainly the market has changed character. Now, turning just quickly, we'll look at the Nasdaq index. It's down 19% from its highs. Bit of a bounce on Friday, but yeah, certainly has accelerated to the downside. Just look at the Russell 2000 on a weekly chart. Again, we've found support. It's holding support at the 50% level, and we may get a short-term counter trend bounce because the RSI is quite oversold, and markets really are quite oversold, and that's why I think a bit of a short covering rally could certainly unfold over the next few days or the next few weeks. Looking at the US dollar index, it definitely has come off a bit in the last couple of weeks. That's helped a little bit because it's helped oil to kind of find some stabilization, and oil had a pretty big reversal on Friday night as well, which also helped stocks. The situation with oil, as we'll see in a minute, certainly hasn't changed. This is all just counter trend noise. It doesn't signal a reversal in any of these markets. And of course, this is the Australian dollar. We've had a big decline in the Aussie dollar. We've now found a level of stabilization since about September of last year. So 68 and a half has been the low, and 74 has been the high. We're sitting 71 at the moment, so we're sitting smack in the middle of that particular trading range. But I think the longer term trend for the Australian dollar surely has to be down. It's pretty hard to see it otherwise, but again, you never know. Turning to commodities now, gold was higher by another $63 for the week. It was $50 the week before, so it's been a very, very strong run in gold. And it's now broken its downtrend and set new 52-week highs. So certainly better signs for gold, finally. So after a 4.5-year bear market, we might be finally starting to pull out of that into something else. And again, that supports what I said earlier about the fear trade. The fear has become quite extraordinary. And hence people are finally looking at gold again. Not because of an inflation breakout, but they're really a bit more fearful about a potential financial calamity. It's very typical in the early stages of a gold bull market for gold stocks to stack on 100% very, very quickly, and we've seen that again. Um, but then again, we've seen that a few times over the last couple of years as well, where gold stocks have had a false start. So it's not an absolute given, but it is that we're going into a new bull market in gold stocks, but it is certainly looking better than it has for a number of years. Now, a lot of people look at that fact that gold stocks have jumped by 100% in a few weeks and they think that it's all over, they've missed the boat. But I can tell you that that's never the case. The really strong upward leg, if indeed a bull market is going to start, is where the main gains are. The 100% gain right at the start it's a big percentage because those stocks are coming off very low values. But in terms of the major gains, then that really unfolds generally after we get a bit of a pullback. Now, the gold stocks, as you know, I've said it many, many times, gold stocks will lead the price of gold in both directions, and miners are outperforming the price of bullion, so that's a better sign. So I'll wrap it up and say that there's a good chance that the trend is changing, but history shows that a pause or a small retracement before the main leg starts to unfold. So gold stocks quite overbought at the moment. I wouldn't recommend buying them at this level, but see if you can start to build some exposure on a bit of a pullback. Let's just look at gold. So there's the price of gold on a weekly chart. Had a little look through resistance and then pull back a bit on Friday. Let's just zero in on the dailies. The dailies gives us a bit of a clearer view and allowed the trend line to be put in a slightly different place. But you can see we have broken that downtrending resistance, but extremely overbought. In fact, more overbought than we've seen for a long, long time. So certainly better signs there. Let's look at the HUI index for gold stocks. And you can see that we've broken now above the red 150-day moving average line. We've formed a base. We've broken above the October highs. We've now broken up beneath these lows as well. These lows from 2014. So an extremely positive move. Broken through the 150. Now, quite often what will happen is that stocks will pull back and quite often retest the moving averages. So those moving averages should start to turn up very soon, and we could see a retest quite possibly in this area through here. So if we get a retracement over a period of a few weeks, come back, slip back into this area, perhaps hold these highs, then I think that would be a good place to be looking at starting to build some exposure into gold stocks. But again, as with many markets, we've got resource stocks that are heavily indebted, and we've got resource stocks that are doing quite well from a debt perspective. So you've got to be very selective about what you buy. Just don't go out and buy anything, because as with oil, we're going to see the better oil companies, they will bounce quite well when the market eventually turns. But the heavily indebted ones could well continue to go down, and the same thing applies to the gold market. Copper slipped back a bit to 204, but it's just fluctuating around with the currency. Crude oil got down to 26 again during the week, but staged a major bounce on Friday night, and that of course helped stocks. But the consistent downtrend in oil, and I don't believe it's anywhere near finished yet, is starting to have a domino effect on the wider economy and many stock sectors, because the oil companies that would have been employing people, that would have been buying equipment, that all starts to flow through the economy. They would have been transporting products, so it starts to impact the transport sector. The ramifications and the ripple effects are quite substantial. I really find it hard to see that we've formed a bottom in oil prices yet, and this came out just a couple of days ago from the International Energy Agency. They said the global surplus will be bigger than previously estimated in the first half of this year, which increases the risk of further price losses as Iran and Iraq bolster production while the demand growth around the world slows. Now that's you can't get much more specific than that. So it's really hard to see how oil has bottomed. Over the last few months, we've seen an extremely high correlation between the price of oil and general stock prices. The correlation has been almost instantaneous. If oil has turned up or turned down, the impact on stock markets has been within a matter of minutes. The correlation is that strong. So if that correlation remains, and we're assuming that the price of oil is going to struggle and could even go lower than $26, then again, it's really, really hard to see how stock prices are going to be able to maintain any sort of upward momentum. There's the spot copper chart. Just to wrap it up, the overall strategic approach. A bounce in the downtrend would be normal. That probably started on Friday night, but the bigger picture is overwhelmingly to the downside, and it's really important, I think, for the foreseeable future that you need to know how to either hedge your existing portfolio so that you can insulate it from further losses, or to in fact outright short sell. Now, if you don't know how to do those two things, then frankly, just sitting with a long portfolio is highly likely to be pretty uncomfortable. And while some people can say, oh, look, I'll just sit on it for, in 5 years' time, it'll be fine. And a very, very small minority of people can do that. The fact is that most people find it extremely painful, and often they will sit and sit and sit, and the market falls, and then they sell somewhere near the bottom. And then they don't buy back in again until the market gets back near the top. And that's the cycle that plays out over and over again. And that's just human nature playing out. So that is the risk in saying, look, I'll just sit through it, because you don't actually sit through it. You change your decision. And if you think about how you reacted in 2008, then use that as a yardstick. Now, of course, short selling can also be very profitable, not just to use it as a hedge. You can have it as an outright profitable trading approach, but it's quite challenging to do because the volatility caused by the sudden short covering rallies that we get make it very difficult for most people to do unless you've got a fair bit of experience in playing the downside of the market. The price patterns are very different because the emotions are very different. We've flipped over from a greed mentality to a fear and panic selling mentality, and price patterns are just completely different. It's a different rule book altogether. So that pretty much wraps it up for this week, but obviously there's a lot of things happening. A lot of things have changed this year. Markets are off substantially since the start of the year in just 6 or 7 weeks. If you want more information, I try and convey a certain amount in these weekly videos, but if you want more information, I'm going to be running a live session in Perth on Monday the 22nd of February for anyone who's in Perth, and there's a link for you to register below. But for those not in Perth, then there will be a webinar to follow shortly after, where I'll be presenting much of the same sort of content as well. So I'll confirm that date once we've made it. So for anyone that is either concerned about their current portfolio and their current positions, or just wants to jump in and avail themselves of the opportunities that are unfolding, then there's my contact details. Always happy to communicate. That's it for this week. Cheers.